So the next gentleman I'm about to bring up has been practicing law in the Greater Phoenix Valley for over 40 years. That's not a bad effort, eh? Yes. So he has really seen the highs and lows of the law practices of law. Look, to tell you the truth, I know nothing about law apart from when I speed, I get fined. So maybe I need to talk to Warren. But anyway, his first 2 years were with the National Certified Public Accountancy firm to get his CPA certificate. He has many, many credentials. He's been with his present firm since 1987, and that's nearly longer than I've been alive. So this gentleman knows his stuff. He actually, one of his hobbies is trains. He loves trains. He would love to own his own train carriage, and one of his goals is to come to Australia to ride our trains. Our trains are all right, yeah? Yeah? When they're working, when they're on time. Yeah, I think that's the same across the world. But anyway, I would love you to give him the biggest warm welcome. Like I said, he's taken time out of his day, time out of his week and month to organise this to be here. So please help me make him welcome, Mr. Michael Margrave.
Thank you. Well, hey, thank you very much. It's good to be here. Stephen, thank you. And I just got an email from Stephen a minute ago, and let me read it here. It says that you all have purchased a round-trip first-class ticket for me to fly to Sydney. So I thank you very much. Did I get that wrong, Stephen? I don't know. Well, you know, it's good to see a group of Australians, and I understand some people from New Zealand here. I was beginning to worry that the Canadians were going to buy up the entire state here. I was up at a meeting in Calgary last fall, and coming back on the flight, there were a whole bunch of happy Canadians. And so I said, well, are you just coming down to play golf? And they said, no, we're coming down to buy property. So, and then I was talking to a CPA I work with a lot yesterday, and she had been at a seminar yesterday, I guess with a Canadian group. So there's competition here, which is probably not bad. This land we're on is, I guess everything comes full circle. This land we're on is a part of McCormick Ranch. And it stretches basically from just south of Shea Boulevard, which is to the north, and down to Indian Bend Road, where my office is on the south, and then from Scottsdale Road over to Pima. And back in 1970, when I was with the first law firm I was with, one of my assignments was working on the McCormick estate. And the matriarch of the family had died, and one of the assets was McCormick Ranch, which was an actual ranch. And so it went into the probate court, and there was an auction sale, and the entire property that I described to you, the boundaries, it was the highest bid in probate at that time. It was like $13 million, and you think, holy cow, what's happened since then? Trains, somebody did mention trains, and I actually have a train car. And that's it, and that's me on the back. It was a few years ago coming from California over to Arizona. But I do want to get to Australia to, is it the India Pacific and the GAN? There's two, one's east-west. The India Pacific is east-west, and the GAN is north-south. So that's in my target to get over there and do that. Well, everybody should have a handout. There's my background's in there. I really won't dwell on that. We do a lot of business law, company law, real estate. One of my partners, Lat Solomons, does extensive real estate, mostly commercial, and but very well versed in that. Well, let me start out by talking about the matters that I'm not going to talk about. Well, it's kind of strange, isn't it? Well, just a couple of points, though, and just to hit it right off the top. Personally, I'll form whatever type of entity anybody wants, but I always like the input from the CPA, the accountant, whether that be in the home country or here or both, as to what they concur is to the best entity based on the income tax treaty that might exist between the two countries as to the type of entity. Many times that's an LLC, and we'll get to it in a little bit. Sometimes it isn't. And sometimes you have the tax reasons for forming a particular form of entity, and then you have some personal and other business reasons. And so sometimes you get into a weighing process. Are the tax benefits more important than the business benefits? And I've got some clients from Germany and who own real estate here. And even though it's not the most advantageous tax way to go, and U.S. Citizens and residents would not go this way, they own their property in C Corp. But they have reasons for it, family reasons, non-business. They're accumulating money here. They don't want to have to do any reporting back in Germany. Nothing illegal. They just want to keep this here and that there. So that's a bridge to cross. And generally, when I'm working with people, I do like to get a letter from or an email from the accountant saying, we've agreed that for tax purposes, this is your best choice, weighing that factor. Nothing worse than to get a letter after the first of the year, or an email or a phone call, and the accountant says, you formed what type of entity for that person? So that's just something to keep in mind. The second thing may not have any applicability to you, but I'll just mention it in passing. If someone is saying, this sounds like a good idea, I'm going to go home, I've got 20 friends, 20 buddies, I'm going to go out and solicit money, and I'm going to form this giant LLC with a bunch of money, you may be doing what's called selling a security. And so there are plenty of exemptions, plenty of exceptions, but there are some compliance issues and some forms to file. And the problem is, if you don't do it and you should have done it, then you can get in trouble, because in the U.S., you have both a federal level of securities law regulation and a state. But if you're not going to get into any of that, it's really not a concern. But I was talking to a friend of mine, a securities lawyer, the other day, and he says, that would be easy enough to cure. Just have the Australians, if they want to go that way, form an Australian company. It raises the money down there, and you comply with any securities rules you might have down there, and then form a company up here and buy the property, and you avoid any U.S. securities issues. Okay. And let's go on here. Okay. Well, I know when it comes to real estate, here in the U.S. particularly, and I just got a drift from sitting in earlier, everybody loves the limited liability company, but let's talk about other forms and ways of owning property, and they're all not good. The first way is you put it in your individual name. I'm coming to the U.S., I'm going to have the title in my name, and that's not good, maybe for tax reasons, but surely from liability reasons. You really wouldn't want to do that. Then you have the general partnership. So let's say you and I form an entity, and we just say, hey, let's be partners. We're going to buy a property, and I've got 50%, you've got 50%. We're going to have a general partnership. We'll do a one-page agreement, and you're off and running. Well, that's fine. The entity will own the property. But if there's a personal injury, a disaster, the insurance isn't enough to cover the losses, then you and I would be jointly and severally liable for any losses and liabilities there. So you really, A and B, not good ways to go. Then we come to C, D, and E. Okay. C is the limited partnership. And a limited partnership is one step beyond B, the general partnership. And because a limited partnership has at least one general partner and any number from one to whatever limited partners. The limited partners generally have no liability. They're there to put their money in, get their returns, and not get involved in the management of the entity, and not have any active role in the business. The general partner does have personal liability. And so what many people do then, they say, well, I don't want to be a general partner myself because then I've got the liability. So what I will do to avoid that personal liability to myself is to form a general partner, a corporation, or another limited liability company that would act as the general partner and would therefore manage all the affairs, but would have no personal, it would have no penetratable personal liability to the owners of the LLC or the corporate general partner. Well, as you could see, a limited partnership is not going to be the vehicle usually when you have one owner. Although we ran into a situation here with a group from Canada. They had their parent company form a U.S. subsidiary. We formed it in Wyoming. And the accountant originally said, let's form a limited partnership or a limited liability limited partnership, which I'll get to in a minute, because under the U.S.-Canada tax treaty, that's probably the vehicle of choice. And again, they had a business reason. They said, no, thank you, but we're going to form a U.S. C corporation, which will be owned by our Canadian parent company. So now, limited partnership. Let me just draw something here. And so that's I'll just put LTD. Can you read my writing? Oh, that's amazing. Okay, you've got the general partner, and you've got maybe one. You could have one limited partner. So you've got a bunch of LPs here. Okay, and that's the standard form for a limited partnership. And you could use this if you have a bunch of investors, if the tax treaty between the offshore country and the U.S. dictates that this may be the preferred form of tax entity. But there is a variation of this. So you say, well, we don't want personal liability. Well, there's a rather recent entity, and it's called the Limited Liability Limited Partnership. Holy cow. So what's the difference? Well, it's kind of the same setup, really. But instead of having to have a corporate general partner or a corporate LLC as the acting entity to avoid personal liability, under this form, the general partner has no personal liability over what the general partner agreed to contribute. So if the general partner can't be socked for some huge liability beyond what the general partner agreed to contribute as its capital contribution. Well, okay. So what's the big deal? Well, under this, if you use the standard limited partnership, then you've got the extra expense of forming a corporate general partner or a limited LLC general partner. And this way you can have an individual here as the general partner, but the liability is limited. So it's kind of, these two devices are more used where you've got multiple investors. I mean, I don't think any of you would be looking at, unless there was some quirk in the treaty, where you would be looking at one of these two most likely. Then we get to the limited liability company. And I understand that you all are enamored of it, as everyone here is. I mean, in the last 20 years or 15 years, in real estate certainly, it is, for us domestics, it is the entity of choice. And it's pretty informal. It doesn't have a lot of formalities to it. You're able to allocate profit and loss and cash distributions if you're into that, and it's very flexible. And so, but my friend, the CPA who does the international tax work, and I'm always relying on her, again says it may not be the choice for all countries. So I got into this rather late, so I haven't had a chance to look at the Australian U.S. tax treaty, income tax treaty. But I'm sure someone here who has spoken or will speak has done that, and you've probably already heard about that. So, so the point is that's a key issue, and so forth. Now, generally speaking, a limited liability company offers its member or members freedom from liability, personal liability. Well, almost. There's a limited area that's developing in the case law that it seems to be limited just to bankruptcy-related situations. But there have been some cases that have said that here's the member, we'll call it the member, and owns the LLC. And here's the creditor over here. And some of these, there's been a handful of cases, maybe a few more, that the courts, basically bankruptcy courts, a few courts have taken the position that the creditor can punch through that. And I guess the rationale is this, is that one of the key things of the limited liability company, and why people like it for liability protection, because it's even a little better than a corporation, is that you get the owner here, you get the entity here, okay? So, and here's the creditor here. Say the creditor sues the owner for something and gets a judgment. Then the creditor says, okay, what am I going to take? And the only asset he could find is the owner's ownership interest in this LLC. So, can the creditor take over the ownership interest in the LLC? And the answer is generally no, because there's a concept called the charging order. And a charging order means that a creditor can only attach property and monies as they are paid out of the LLC. So if nothing is paid out to the owner, then a creditor can't take over the entity and can't reach any of the assets within the entity. Now, with a corporation, I know I'm jumping ahead a little bit, but it's a different, with a corporation. You have the shareholder of the corporation, owns the corp. Now, let's just say we've got the same creditor, gets a judgment. Well, the creditor could take the shares of stock and therefore take over the ownership interest of the shareholder in the corporation. So that's viewed as an important protection. But some of these bankruptcy cases that have come along have said, well, wait a second. If you've got multiple owners, then this charging order concept makes sense. We can see a reason why you don't want John creditor stepping into the shoes of the owner that got sued and has a judgment against him, and then you're doing business with somebody you don't want to do business with. We'll respect the charging order concept. But if it's just one owner and it's owning an entity, and there's a judgment against the owner, then we're not gonna enforce this charging order concept, and the creditor could take this. You know, that's hopefully none of you will be in that situation where you're up here and there's creditors coming along, but you never know. And so that is an important distinction between a corporation and a limited liability company, is this charging order concept. So it does in effect offer more protection, but if you're in an entity that has one owner, then you do have some courts, not all courts. It's not a nationwide avalanche, but there are some court decisions popping up in bankruptcy court where this protection is being ignored because the courts say there's no rationale for the charging order with a one-owner entity. Now, there are two types generally in the U.S. Of limited liability company structures. And one of them is member managed. And the other one is manager managed. So under this structure, number 2, you've got members that own member or members, and then you have manager or managers that run the day-to-day. Well, you know, I guess we all have our little preferences and so forth, and I've, over the years, have kind of liked this form better. The manager-managed company versus the member-managed. So this has the manager-managed here, and I'll tell you why, especially with a one-owner LLC. And I've seen it happen before, that there's a member-managed company. It has one member, and it's member-managed, one member, and the member dies. And, you know, say you're in the middle of a real estate contract. And so what happens? Well, I mean, if you're dealing with real estate up here in the U.S., out here in the West, it goes through a title company. And the title company is going to say, we want to see all the paperwork for the limited liability company. Show us the operating agreement. I'll get to that in a second. And they're going to say, well, wait a second. You know, Mr. Smith is the sole member. It's a member-managed company. Mr. Smith dies. You need somebody appointed in court that can take over his position. And so that's why I like manager-managed, because you can have in the operating agreement a provision that says, okay, Mr. Smith is the owner, and Mr. Smith is the initial manager. And if Mr. Smith can't continue as manager, then here's how you pick a new manager. So if you follow the operating agreement, then you're home free. And so while we're talking about that, the two primary documents that you get are and each state is different, but we'll just use Arizona to start out with. And the first document, Articles of Organization. This is the charter document. This is the document that is delivered to the state. I can't talk it right at the same time, sorry. And this is what gets the company up and running. So like, for example, we have a fax file. And so we have a deal with the Arizona Corporation Commission. So if we form an entity, we just fax in the articles and it's deemed formed when they receive it. But this says, you know, if it's member managed or manager managed, it says who's the statutory agent. We'll talk about that a little bit later. And any other, there's about 4 or 5 provisions you put in there, and it's not that difficult. Then you have the operating agreement. Well, certainly with multiple members, you really need an operating agreement for sure. And even with one member, we recommend people to have an operating agreement just to deal with the situation I told you about, death and things like that. But this has all of the rules of member relationships. What are the powers of the members? It has the sections on managers. If you have a manager-managed company, what can the managers do? Are there any supermajority votes? Are some things beyond the authority of the managers, like you have to go back to the members and get approval? I mean, those are the kinds of things that can be covered in an operating agreement. Sometimes the operating agreement will have buy-sell provisions if you have a couple of owners, and sometimes there's a separate buy-sell agreement, but usually you can cram it into the operating agreement. Why would you want that? Well, if it's one person, you really don't need it, a buy-sell provision. But if you have two members or more, then you're always dealing with death, disability. Somebody wants out. I've had it with you. I don't want to do business with you anymore. And if you have a mechanism that is a peaceable way of extracting people, I tell people, you can pay us now or you can pay us later, because if you've got multiple members and you don't do a buy-sell agreement now, then if you have a dispute, that's when we really make money, because people go to court and you can spend hundreds of thousands of dollars fighting, and it's really not worth it if you had a decent little buy-sell agreement. So that's kind of how the mechanisms work. And there is one other point, though, and I'm not professing to be a tax expert, but I am going to make a few comments. The general rule is that a limited liability company is a flow-through entity. So it's not a separate tax reporting and tax paying entity. It's a tax reporting entity, but not a tax paying entity. And then there's even one further deviation from that. If it's a single owner limited liability company, then our illustrious Internal Revenue Service says that's going to be regarded as a disregarded entity, which means that everything is taxed to the owner on the owner's return. So if you have a single owner LLC and end of the year when you do the taxes, well, you're not going to be filing a separate tax return. It's going to be on your own return. And so sometimes what's happened is, and again, I keep going back to these income tax treaties, but the CPA keeps telling me, sometimes people wake up and they say, oh, I've got to file a non-resident U.S. return because all of the income earned by that entity is taxed to me, and so that's something you need to consider. But there's even one exception to that. And I think I don't like tax forms, but I brought a couple over here just to show you. And here's a form, 8832, again, an Internal Revenue Service form, and it's called Entity Classification Election. So what this means is that, okay, you're a LLC, it's a single owner. Normally it would be regarded as a disregarded entity. But there is an opportunity within a limited time frame. You can, what we call over here, check the box. So on page 2 of this form, it says type of entity. And the first one is, check it, a domestic entity electing to be classified as a corporation for tax purposes. So we had a German client, and it just bought an office building, and wanted to have an LLC. We did an LLC. Then he said, well, I don't want to have to file anything in Germany. So we said, okay, we need to make the election to check the box and have you taxed as a C corporation. And I'll get into that in a minute too. So there's various ways of dealing with things, and that's why I always say, hey, get a good accountant, because it's very important that you have a good accountant and who can steer you with the good tax advice. And I have people that they have their home accountant and then they have one here, and those two get together, and it's not that bad, but it's all I'm trying to convey is it's good to have a team. You know, have a lawyer to help you with the legal stuff, have the accountants help you with the tax stuff, and then you sometimes have to weigh things. Well, what's more important, business, personal, taxes, and then you make your decision what form of entity to use. Okay. With limited liability companies, there's not a lot of formalities that you need to do every year. And like you don't have to have meetings. And we'll talk, when we get to corporations in a second, we'll talk about that a little bit. So they're a little more informal, less to do, and that's one of the reasons why some people like them. They're less formalities involved. And they're flexible if you're allocating income and deductions and all that good stuff. But the corporation then offers limited liability, but remember that concept, the charging order concept that's unique to the LLC, that the shareholder of a corporation isn't protected in his ownership of stock if a creditor comes after him or her. But it still has a high degree of limited liability. And that's why people form corporations. Over here, for us domestics, as I say, a corporation is a bad entity to own real estate because you have the concepts of, well, first of all, the income tax rate for a corporation is the same whether it's ordinary income or sale of property. There's no preferred capital gains rate. So right off the bat, that's not good. And then you can have the issue of double taxation, which can hit you. And that means that, okay, you put in $100 into the corporation for your stock. The corporation then goes out and buys a piece of property. You sit on it for 10 years. The corporation sells the property, pays its tax based on the net sales and the basis. And then you say, well, let me liquidate the corporation and get the money out. And that's when you have a second tax based on the difference between your basis and your stock and what you get out of it. So that's why, absent some tax treaty or other considerations, corporations aren't usually that popular, but you need to know about them. Now, there are two types of corporations, and but this is purely from a tax standpoint, because a corporation is a corporation is a corporation, and I think I said that in the handout. But for tax purposes, you often hear these terms. Are you a C corporation or are you an S corporation? Well, what's the difference? I mean, corporation looks the same. It was formed the same way. The corporate documents are the same. This is merely tax jargon. The C and S are different chapters under the Internal Revenue Code dealing with corporations. A C corporation is a corporation that's both a tax reporting and a tax paying entity. All right? So it pays and reports. The S corporation is an entity which is only a tax reporting entity because it's a flow-through entity. But the problem for you guys is that an S corp is not available for non-residents of the U.S., non-citizens. So some people own real estate, domestics own real estate in an S corp, and there's some fine differences tax differences between an LLC and S corp that I'm not going to get into, but the accountants can certainly differentiate. But basically, they serve the same concept. But so if you hear people talking about you need to form an S corporation, say thank you, but that's not going to happen under the current U.S. rules. As I said, corporations, but I'll just give you a little overview of a corporation and the structure and so forth. The corporation, the operative documents are the Arizona Articles of Incorporation and the bylaws. I told you I can't talk and write at the same time. And so again, this is the charter document that's filed with the state, and the bylaws are the internal mechanisms. When do you have meetings? How do you have meetings? What are the officers, and so forth. And so there's a bit more formality with a corporation. And some people like that. They like the structure, and because in a corporation, you really have 3 tiers of people. And of course, they can all be the same persons, but you have the stockholders at the bottom of the list. They own it. Then the stockholders are going to elect the board of directors, what we have over here. And then the board of directors elects the officers. And it could be the same person wearing all 3 hats. But that's just the way our corporate structure is. In theory, the board sets the overall direction and policy of the company, and the officers run the day-to-day. So you wouldn't, in the U.S., you wouldn't have board of director member signing a contract or negotiating a contract. The board of directors may say to these folks, you negotiate the contract, you get it executed, and here's your marching orders. So that's the difference in the structure versus the limited liability company. You can have one that's members only, member managed company, or you can have the manager managed, where you have the members owning it and they pick the manager. So some people like this, corporations for the structure, but generally in real estate, you don't choose a corporation if you don't have to, unless there's some other personal, business, or financial reason for doing that. Okay, let me go. I'm getting good at this device here. Oh, that's bad. Okay. Now, you've decided you're going to an entity, you've picked out the entity that you're going to use, and you say to the lawyer, okay, let's go for it. So if you bought property in Arizona, I mean, probably the easiest, simplest, most straightforward way would be to form an Arizona entity. It's pretty quick, it's pretty reasonable, and you know, it's not a bad way to go. Probably most people would go that way, 80% of the time or better. Now, but you don't have to. We've got 50 states, and we have 50 different corporate or limited liability company structures. And I sure don't know them all. But I do know a few states. And the other state I like, if the choice is made to form an entity in another state, is Delaware. And why Delaware? Because that's probably the principal state for corporate and company rules, regulations, stability, business favored in the courts. So it's got a long history of legal decisions. So, and it's being cloned by a lot of other states. I mean, Nevada has basically tried to take the Delaware corporate code and made some changes, but is taken. And then I was at a mergers and acquisitions seminar the other day, and somebody was talking about now a state you probably never heard of, way up north, North Dakota, has now gotten into the business of trying to be a beacon for business formations. Well, the point is, though, why would you want to do that? Let me give you a couple of examples. We file in Arizona, and we do it right in our office. It goes the Corporation Commission. We pay the expediting fee, and we'll get a recognition, acknowledgement back, pretty quickly. But it may be a week before we get the actual paper copy with the seal on it. And so if a real estate company, the title company says, well, we want proof that the entity's been formed, and we're not satisfied with just an acknowledgement, we want to see the real thing. Well, if time is of an essence, Delaware is an example of where you can really move. And let me give you a couple of, they have a 4-tier system in Delaware. And so if you want the super duper fast, which is 1 hour, you fax your articles in 1 hour, you're going to get them back. Now, the bad news is they charge you $1,000 for that speed. Then there's the next one is, and we just did this a week or two ago, the 2-hour service. So we had a client who was buying a business and before it went under, and so they needed to get the documents in place. So we did the next in line, number 2, and that was $500. But, 2-hour service, if you need it, and you pay it. If you don't need it, then it's not an issue. Now, privacy. Some states, if you could file in Arizona, it's going to be posted online in a due course, and so you can go in there and type in the company name, and you can see, well, here's the name of the member and the manager, or here's the officers and directors and the greater than 20% owners, and if you're fine with that, that's great. Some people don't like it. I've got an example for you. This is my classic. I had a client about 6 months ago, and he called me one day and he said, hey, I'm buying this house on Camelback Mountain. I don't know if you've seen Camelback Mountain. Yeah, it's just down the road here, and I'm paying $4 million for it, but I don't want anybody to know about it here. What can I do? And I said, we can form you a Delaware LLC, and nobody's going to know who formed the LLC because that's just not published back there. We said, well, how much is it going to cost? And I said, well, it's going to be, maybe $400 more than Arizona. It's a little more expensive and so forth. And he said, I'll get back to you. So 2 weeks went by, and every Wednesday here, I don't know if anybody's told you, but every Wednesday in the business section, page 2, they have the top 5 house sales in the valley. So I was in there drinking my coffee one morning. I was looking at page 2 on the high-end home sales, and number 2 on the list, it was ABC LLC in Arizona, limited liability company owned by my client, just purchased this house. So I called him and I said, hey, for $400, you got a lot of cheap publicity. And he had about a 2-word answer for me, and he hung up. So anyhow, but then we get to another concept, because that's a concept where you form an entity, you're not doing any business, so it doesn't matter where you form it, and you can own an asset. But if you're going to engage in business, and let's just use that as an example. And this is true whether it's a corporation, an LLC, a limited liability company, or whatever. But let's just say property, let's say rental property, Arizona. And let's just say it's got to be done quick. So we form an entity in Delaware. That's the domestic state. So this is a formed, LLC formed. Okay, so what do we have to do then? Well, if this entity is doing what's regarded as doing business, in Arizona. It's not a big deal, but it qualifies to do business in Arizona. There's a form to file, $150 or something to pay, and then you're all up in good standing here at Arizona. So this is different than my tight-fisted client who didn't want to pay the $400 extra because he wasn't engaging in business. But just keep in the back of your mind, if you form an entity here and you're doing business here, then you're going to have to qualify it to do business here. What happens if you don't follow that procedure? Well, all the contracts are good. Nothing's disregarded. Doesn't have any impact on your business dealings, but you couldn't maintain a lawsuit if you did fail to qualify here. If you had a tenant who stopped paying, you were a Delaware corporation, you didn't qualify, and you say, let's sue that tenant for the rent. Problem is, if you didn't qualify here, you've got to qualify before you can file suit. And some states, if they know you're doing business there but didn't qualify, they'll assess you for prior years' fees and so forth. So probably at the end of the day, that's worth doing. Now, let me see here. Let me go up, see if I've, oh, okay. Okay, and this kind of ties together because if you've got, the next question that comes up is, what if you're buying multiple properties? And I had a situation, in fact, the CPA that does all the international tax work, she's having us form an entity, and she and her husband have 2 rentals. I think she told my assistant, but they decided to go with one LLC. And that's fine, but here's the consequence of that is that you have property 1 and property number 2. And let's just say you have a disaster, a liability disaster on one property. You know, there's a family of 8 and the gas heater blows up and, you know, the damages are more than your insurance. Well, in a lawsuit, of course, the people that are suing are going to take this property. You can bet on it if your insurance isn't adequate. So that's an argument for, sorry to be going through all this paper. That's an argument that we always ask people to consider. If you have multiple properties, it's going to cost you a little extra money, but it's kind of like an insurance policy. And in the long run, it's probably better to have one entity per property. And then coming back then on the multiple properties concept, let's say that you're getting a property in Arizona, and you find one in New Mexico, and then you have one in Texas. And so then the question is, okay, for one thing, I'm probably going to have, this is probably a case where you're going to want separate entities. But then the other question is, where do you form your entities? And we're kind of going back to that earlier question. You could say, well, I'm going to form an Arizona entity to own the Arizona property, and I'm going to form a New Mexico entity to own the New Mexico property, and a Texas entity to own the Texas property. Yeah, that's fine. But there is the argument that, wait a second, you know, we've got 50 states. Every state has its own rules, corporate LLC statutes. They're all different. And so you're going to be spending time saying, well, what do we need to do in Arizona or Texas? And so there is an argument, and that's where that Delaware thing comes back in, or wherever, that you say, okay, just so I keep it simple, I'm going to form 1, 2, 3 Delaware entities, because then I know what the rules are for one state, and I don't have to be hiring a lawyer in each of these 3 states to be dealing with laws and forming in those states. Just a thought. And then going back here to, well, I'll do a fresh one. Holy, I better stop here. Another concept is why it's good to have one entity per property is this. Okay, say you have one LLC, LLC number 1, that's all you have, and you own 2 properties. And lo and behold, somebody comes along and says, hey, I really like this property. And you say, fine, I'll sell it to you. Yeah, a great price, okay. But then the guy says, well, wait a second. I really don't want to buy the property and have it in my name on the public record. What I'd like to do is buy your entity. And then you say, well, wait a second, I got another property in here. Now I'm going to have to take that out. I'm going to have to do all this. So that's another reason why one entity per property is not a bad idea, because then you can either sell the property or sell the ownership interest in the entity. So now, let me see here. Oh, there is a couple of other things. I hate these forms, but there's Stephen wanted me to talk about, and fortunately, I don't know why, but I happened to bring a couple of forms along. And but it's a very good point. And well, that's my predecessor. I think we're getting close. Yes, okay. In the U.S., every entity has gets a employer identification number, an EIN, and that is Form SS-4. And you fill out a whole bunch of stuff on here, and you get to the point at question 7A, name of responsible party, all right? And then 7B is, what is that person's social security number, which you don't have, EIN, which you only have if it's an entity being the responsible party, or the ITIN. Well, who is a responsible party? And the responsible party in the instruction forms is anyone who has basically some control, direction, and can act on behalf of the entity. That's a responsible party, so that person has to be listed. Well, you say, holy cow, I've got to get an ITIN, and that form is over here. I don't know why I brought this today. It must have been ESP or something. But this is W7, Application for IRS Individual Taxpayer Identification Number. And as usual, the good old IRS comes out with about 10 pages of instructions, and which I'm not going to get into today. But it is possible for all of you to get an ITIN? Yeah, number. And that's great. And then you say, well, wait a second. I need to get a tax ID number. We're closing next week, and I'm never going to get the answer back from the IRS in that period of time. What do I do? Well, I've seen people do this. They will go to, somebody they know in the U.S., maybe their accountant, and say, hey, I'd like to make you assistant manager for a while, or I'd like to make you assistant treasurer. You're going to be the responsible party, and so I can put your name in, your social security number, send it in, and get an EIN. And the difference is, with the ITIN, you've got to mail it in, and it takes, I don't know how long. With an EIN, we get those routinely in about 15 minutes. I mean, we get them right in our office, but you have to have a responsible party. And If you're going to be the responsible party, it's going to take a little longer. If you can cajole somebody up here to be the responsible party, then you can get that done a lot quicker. Talked about that. Okay, let me go back a little bit to this concept of doing business in a state. Because, and that kind of went back to my tight-fisted friend who didn't want the Delaware entity, so his name wouldn't get in the paper. But doing business, I could bring in a book, and it would summarize the laws of the 50 states about what does or doesn't constitute doing business in a state. And it's a little bit about the nature of the activity, your presence in the state, and how that state views it. Let me give you an example. If you were to have a sales business and you say, I'm going to send my salesman over to New Mexico to try to sell some product and bring in some orders and come home, that's not doing business for having to qualify there as a foreign corporation or LLC. But if you set up an office in New Mexico and you say, I'm going to have a sales office here, I'm going to have people employed here out in the street and selling, that's doing business. And then you get all of these gray area things. Well, it might be, it might not be, but in your case, it's probably not going to be an issue because if you're renting property, that usually is regarded as doing business in a state. So if you form it in Arizona and that's where the entity is formed and that's where the property is, yeah, that's not a big deal. If you're going to form the entity for whatever reason in another state but have it do business at Arizona, then you need to address that and so forth. Okay, here's another term that comes up, and just so you're aware of it, I'm going to start conserving paper here. The term you'll often hear, statutory agent or registered agent. And all that is really is a person who is usually a resident of that state who is available to accept service of process in the event of a lawsuit, and usually gets the tax mailings and so forth, but has no really authority or other role in the company. But here's the point, though, that if you may say, I'm going to form an entity in Arizona. Like our law firm, for example, we have a little subsidiary company. All it does is act as statutory agent. I mean, that's its only function. But if you go to say, let's go to Delaware and we're going to form the entity there, then you have to have a statutory agent in Delaware, and it's usually one of these companies like CT Corporation System, and they charge you an annual fee, maybe $350 or whatever, to fulfill that role, and that's just the way it is. You're going to have to pay that bill. If you form in another state, you're going to need a registered agent or statutory agent in that state. Annual filing fees. This is all over the place around the country, anywhere from nothing to a lot. And one time, about 25 years ago, we formed a Delaware company, and I won't go in to bore you with all the details, but they have what they call a franchise tax, and it's based on the number of authorized shares. So somebody at the office brilliantly put in, this company is authorized to issue 1 million shares. And so the tax bill comes in, your annual franchise tax fee is $16,500. I mean, we almost had mass suicide. But at the end of the day, they have an alternate formula, so we were okay. But that's something to keep in mind if you do go outside the state. Arizona, a limited liability company has no annual fee. There's no annual fee. With a corporation, I think it's like $40 a year, and you file there's a form to file. My paralegal does those, and so there's a little bit there, but there is some filing. Annual legal maintenance. Well, with a limited liability company, there really is no maintenance to speak of. With a corporation, two ways to go on corporations. Supposedly, you have an annual meeting and of the directors and the shareholders, and there's some abbreviated minutes that you prepare and slap in the corporate minute book, and then everything looks nice and pretty. And with a corporation, why is that important? Well, for two reasons. The IRS, if they ever audit the corporation, will look and see if it's been handled and operated as a corporation. And if it hasn't, then they might ignore it for tax purposes. And then creditors in lawsuits also look. And if they see that they didn't have annual meetings or there's no minutes at any time, no formalities were kept, the owner paid for his boat and his airplane and family vacations out of the corporate bank account, then we've got a problem. So it's the legal maintenance for a corporation. What we do, some clients, we just say, here's the form, you fill it out, send us the original, we'll put it in the minute book. Some people say, we want to come in for a meeting, so it's all over the place as far as what we do. Annual accounting costs. Well, if you're probably going to have a tax return, then you're going to have some accounting costs to prepare a federal and state income tax return. We have two levels of tax here, federal and state. So there's a federal, and usually the state tax return is a copy of the info on the federal return. So at least that's not a bad thing. Now here, this is interesting because this shows you how the practice of law varies around the U.S. Here in the Southwest, in residential transactions, lawyers really have nominal involvement. And I bet in all the years I've practiced, which is more than I'm wanting to remember these days, I bet I've had less than a handful of transactions that I was, got involved in the legalities of the residential transaction. In the Midwest and back east, I mean, they're more inbred. And so I don't think any real estate transaction is done without the lawyer getting involved at multiple levels. So that is an oddity out here. And now in commercial transactions, that's totally different. But in residential, you're probably not going to see the bulk of the time, gee, we got to send this to the lawyer. Now, if you want to, fine, but that usually doesn't happen like that. How are we doing? I know you're all eyeing the door so you can storm out for some cocktails, but I'm getting there, and then we'll have some questions. But lawyer relations, that's involvement relations. So involvement can be all over the place. Let me give you some examples. We've got some clients that we probably do more than I'd like to do. And I don't mean that in a mean way, but I mean, we've got some clients that they call and say, hey, find me an insurance agent. Where should we bank? Can you overlook this and this? Help us get straightened out at the bank. So, and other clients, we, have nominal involvement. So that's kind of a personal choice, a relationship, and it's all over the place. So I don't think there's any rule of thumb there as far as what the nature of the relationship is. Usually lawyers here, like the State Bar of Arizona, regulates the practice of law in Arizona. When I started, somebody walked in the door, hey, I need something done, fine, I'll do it, and off you went. As the number of lawyers has increased, there have been issues of some sorts over the years. The State Bar has encouraged lawyers to avoid misunderstandings with clients, to set everything out. You ought to do a fee agreement with the client. here's what we're going to do, and here's what we're going to charge you, and here's how we expect to get paid. So if you go to a lawyer and say, gee, I'd like to form this entity, don't take it personal or shocked if he says, okay, we'll be glad to help you. Here's a little, 2-page fee agreement that we need you to sign, and so forth. Stephen, anything that you think I didn't cover? Therefore, I know you don't have any questions, but I'll still take some if you do. Yes. Any questions? I'm happy to take questions. Yes, ma'am. There you. Okay.
You mentioned before that there's not much legal involvement with residential property. What about conveyancing? Do you have very good
No, really, and it's odd in the residential area. No, I would say most times it's your real estate personnel, the title company, and that's it. Now, there are occasions where maybe a property has deed restrictions, or maybe there's some zoning issues, or some technical things, or maybe you want to craft some contingencies in the purchase agreement where you'd say, I'll go to a lawyer and have them look at this. But in the standard, typical residential purchase, you really don't see much lawyer involvement there.
Does that mean the real estate agent does what an Australian conveyancer would normally do?
Well, they'll write up the contracts, and then, the process is you get a contract signed up, you open escrow, you go to one of these title companies, and they'll open escrow. The title company will do a preliminary title report or a condition of title report. You'll get that back, and it'll say, here are the liens against the property, here are any tax assessments due, and then if everything is copacetic and the people get their money together and the deeds are prepared and you close and you're off and running.
Thank you.
Yes, anybody? Anybody from New Zealand here?
Yes.
Oh, really? One of my classmates is from way back in high school in Omaha, lives in Nelson on the South Island.
She's from Nelson.
You know Mike Brady or a Yolanda Brady? That's like asking somebody, there's 50,000 people, do you know somebody? But anyhow, interesting. So you're from Nelson. I'll be darned. Okay. Well, if you have no more questions, yes. Yes,
Just talking about the Canadian groups before, I'm just wondering how many of those groups have come through.
say that, I'm sorry?
You were talking about a lot of Canadian groups have come through.
Yes.
Investors. Have been a lot of groups through, or?
I have not participated in any seminars, but based on my Calgary experience and then the CPA, my friend, the tax lady, she was at a program yesterday. So they are more, if you, going back to this Wednesday, page 2 of the business section of the paper, there's some cash purchases in there. And it's funny, about a year ago, the highest prices were about $1.2 million and $1.3 million, and now they're inching up again. So the high-end prices seem to have stabilized and they're moving up a little bit. But I know that just the proximity, we get a lot of traffic from Alberta and BC, British Columbia, Manitoba. Probably not so much from Montreal and Toronto, but some from Toronto. But there's a pretty heavy Canadian involvement here, yes. Yes.
Hello, my name's Ken. If we are getting a property and we're looking at getting a tax identification number, and that would be got through perhaps somebody like yourself who'd act as our agent, is that correct?
Say that again.
If we're getting a tax identification number.
Tax ID number.
Yeah, that would be done through a responsible agent in the local.
Well, we get them for people. The accountants get them. If you have a local accountant, would get them. It's just in filling out the form, that line responsible party, and that's where the bugaboo can be. If you're on a tight schedule for closing, you almost need a U.S. person to, at least for a bit of time, be an assistant treasurer, an assistant manager or something, so they can, then you can just, online, you can get the tax ID number online.
Okay, so on that basis, is that if we are going to engage you, is that something that we actually physically have to come and say to you now, we wish to engage with you, please provide us with the fees structure and that sort of
Oh,
stuff?
yeah, we would, we're happy to discuss that with you. And kind of what I like to do is, is just to say, okay, what would you like us to do? And we define our little world here, and then we say, well, it's going to run, either this range, could be a fixed fee if it's something simple, or you may say, well, I want you to do this, 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 and this, and we'd say, well, here's what it would entail, and you could say, well, I don't want you to do that then. So, we'd be happy to talk to anybody, and sure. And well, that would be, that's a topic on the table, what do you charge, but I found over the years it varies a lot because people have different demands and expectations. And they say, well, can't you give me a flat fee? And well, yeah, but if you want me to do these things too, then it's going to be a little more. And so let's look at what you want, and then we'll establish that. Yes.
Quick question. With the local accountant getting your EIN, do you have to minute that?
Do you have to?
Do you have to put that in the minutes that you've nominated them to act in that position?
Oh, a
do
responsible
they just
party?
put it on the EIN form, or?
Just on the EIN form. It's, here, I'll just show you. It's, it's right here, and you enter the person's name, and if it's a U.S. person, you would put in their social security number. And so then they would probably be the one that signs the application form, and then it's, we get a hard copy, but we obtain it online. So we just get it. But then that's the response. Then you can get it in 5-10 minutes, That's the beauty of it. But if you go the other way, there's, it takes a lot longer.
And just one other quick question. The difference in the states, if you have an LLC in one state and you purchase property in another state, you can't sue your tenant. Can your tenant sue you, even if you haven't qualified to practice in that state?
Oh, they could, it's only if you are doing the suing that you need to be qualified in the state where you're doing business.
So you can still get sued.
So the tenant could sue you there.
But you'd have landlord's insurance.
Yeah, you would get insurance. And I would, I don't know how it is in Australia, but for sure you would want liability insurance, casualty insurance, and to cover all of that. And that would be the prudent way to go, for sure. And so it's not that difficult. It's a different world for you, just as if I were to go to Australia and you'd say, here's how we do things here. And, okay, take a bit to absorb it, and then off you go. Once you get into it, it's pretty straightforward. And so going back to the entities, I mean, it's like everybody loves the LLC, and it is flexible, and has that extra protection on the charging order. It's just you need to verify with the accountant that under your tax treaty that's okay. And then ask it, do you have to file any U.S. returns? I mean, do you have to file a non-resident return in the U.S. if you own an LLC as a sole owner? And, maybe the tax treaty governs that and says you do or you don't. I know in some countries, they don't recognize LLCs, and so it's not clear how they treat LLCs for tax purposes at that end. So that's why we get into some of these variations about the limited partnership or the limited liability limited partnership, or in some cases a corporation. So, unfortunately, there are more popular entities than others, but there's probably no one entity that's going to be the right entity in each and every case because of all the varying factors that are involved. Okay? All right, yes.
Hi there, my name is Richard. I had a question regards, you talked about the the LLC as an entity that protects, stops the charging order or prevents the charging order, and you said it's optimal for one owner. Is that for joint names as well as family trusts? I was just wanting to define
No,
that one owner.
the charging order in the statutes is good no matter how many members there are. It's just some U.S. bankruptcy courts have, maybe 4, 5, 6, 7 jurisdictions, have taken the position that if the entity files bankruptcy, that there's no basis for that charging order protection, and they'll let the creditor go right to you. But if you don't file bankruptcy, you're not going to be faced with that issue. And it's the rationale is if you have multiple owners, then the charging order is important because owners A, B, and C don't want to have to deal with owner D's creditor who's now stepping in his shoes and a member of the company. And so that's why that charging order prevents that. But if it's you and your LLC and there's only one member, then some of these bankruptcy courts are saying, well, look, there's no rationale for offering that protection. We're just defeating the creditors here, and that's a protection that really shouldn't be intended for the one owner LLC. But if you don't file bankruptcy, you're not really going to have an issue there. I think I gave everybody a little handout and a card and summary. If you want to email me or if you have a question, be glad to answer it for you. Any other questions? Yes, sir.
Title companies, are they private organisations that do the title?
Yes, there's a couple of big ones, Lawyers Title, Chicago Title, First American Title, and then there's some smaller ones, but they're all privately held companies. Most of them are, a lot of them are publicly held companies.
Yeah.
Yeah.
In Australia, that role would be covered by a government department.
When I say public, I mean publicly owned, not a governmental, yeah. Okay. Okay, all right, thank you very much. Enjoy, one more?
Just a quick one. What's your view on having a LLC as a head for... What's your view, Michael, on having an LLC as a head LLC for all your other LLC companies?
We do that.
Yeah.
And you use it as a holding company, and it's just an extra buffer between the owners and the entities, and it wouldn't be appropriate in every case, but there are definitely situations where it's useful.
Does that provide some protection from that case of bankruptcy with that one owner?
Interesting question. I don't think I can answer that without reading some of those bankruptcy cases.
Yeah. I'm just thinking why that structure was in place.
Yeah.
Because you've got to supply individual tax returns for those LLCs anyway, so you wouldn't aggregate them in the head.
No.
So there's no benefit there. So the only other benefit would be some form of asset protection in that structure. But
Yeah, I would say so, yeah.
And just one other quick one, just on that IRS form you mentioned where your LLC gets elected to retain.
The check the box
the
form.
check the box form. Is that, I've heard it referenced or referred to as a LLC acting as a C Corp. Is that what you classify that as? Okay.
Yeah, and I think I mentioned we had a German client that formed the LLC, then decided he didn't want the tax reporting back and forth.
Yes.
So we checked the box and because as long as he doesn't take out a salary or dividends or anything like that, he's got nothing to report back in Germany.
So that's a case where you want to retain profits in the US and obviously don't want to draw them across to the Australia.
That would be a case where, and as I said, here the C Corp is anathema for owning real estate. I mean, that's the worst thing you can do. But there are cases where, business reasons override tax reasons.
Yeah.
You see that all the time. Okay, thank you.